Hi, I'm Tim Koller, a partner in McKinsey's corporate finance practice. In this video presentation, I'm going to show you what we at McKinsey consider every executive's essential guide to corporate finance. It's one thing for a chief financial officer and his staff to understand all the technical issues of value creation and to apply those tools to make acquisitions or other investment decisions. It's much better, though, when the CEO and as many non-financial executives as possible understand exactly where value comes from, how to create it, and how to avoid destroying it. If they can master a few core principles with value creation in mind, they can all make better decisions with more confidence, make tough decisions with more courage, knowing that creating value is at the center of what they are doing. Last year, some colleagues and I decided to boil down those few core principles, or cornerstones as we call them, and to explore them in a new book. The finance world is also full of myths and misconceptions, so we sorted through those too in order to make it easier to spot common finance traps. We settled on 4 basic principles that executives can use to make better decisions and to avoid the mistakes and damaging excesses we so often see. In this presentation, I will explain each of these 4 principles, demonstrate how each one works, and illustrate how they show up in real business situations. Because these principles build upon each other, I recommend that you view them in sequence, starting with Cornerstone 1, the core valuation principle. We enjoyed creating this tour through our thinking about corporate finance and how you can use it to make the best financial decisions. I hope you enjoy it too, and that it helps you create more value for your company. How do companies create value? That's the fundamental question behind all business decisions. Do you create value by growing revenues, by growing earnings? What are the things that you need to keep your eye on to know whether or not your company is creating value? Fundamentally, value is created by the cash flows that a company generates. Companies create value by investing capital to generate future cash flows. Those cash flows are determined by how fast the company can grow its revenues in particular, and the return that the company earns on the capital that it invests. So it's the combination of growth and return on capital that drives cash flow that ultimately drives the value of the company. We call that the core valuation principle. So let's explore why it is that revenue growth and return on capital drive cash flow and value. You'll notice that I haven't mentioned earnings. It's not that earnings are not important, but it's perfectly reasonable to see 2 different companies with similar earnings and similar earnings growth generating different amounts of cash flow. The reason for that is that they generate different returns on capital. Returns on capital are what translates revenues, revenue growth, and earnings growth into cash flows. So ultimately what matters is revenue growth and return on capital, which in turn drive earnings and cash flow and therefore value. Let me illustrate how this simple chart actually mimics the value of real companies. The typical large company has a cost of capital of about 9%, which this chart is based on. The typical large company also has a return on capital of about 13% and a revenue growth rate of about 4 to 5%. If we look at the intersection of 13% and 4 to 5% growth, you'll see we'll end up with a company which is valued at, say, $1,500 to $1,600. We've assumed that this company starts with earnings of $100. So if we divide the $100 into the value of the company, we end up with an implied price-earnings ratio of 15 to 16 times. Not coincidentally, the typical price-earnings ratio for a large company in the US or Europe is about 15 to 16 times in most periods when inflation and interest rates are at reasonable levels. So this simple approach does a pretty good job of mimicking the way the real world works. Now what I'd like to do is explore how changes in the return on capital and growth affect the value of the company. First, let's explore return on capital. As I go from left to right, for any level of growth, I'm increasing the return on capital. And if you look across any line from left to right, you will see that the value of the company increases. This means that improving return on capital, if I can sustain the same level of growth, always creates value. So higher return on capital is always better. The same cannot be said for growth, however. Let's look at how growth affects the value of the company. Remember that the cost of capital for this company is 9%. If I look to the right-hand side of the chart, where the company earns a 25% return on capital, as I grow faster, as I go from top to bottom, you see that the value of the company increases. So more growth at a 25% return on capital definitely increases the value of the company. Now let's look at the left-hand side, however. On the left-hand side, the company earns a 7% return on capital, below the 9% cost of capital. What happens as this company grows faster? As you can see, as I go from top to bottom, from slower growth to higher growth, the value actually declines. Why does it decline? It declines because as I grow faster, I'm investing more capital at a 7% return when investors are demanding a 9% return. So as I grow faster, I'm effectively destroying more value, and the value of that business will decline. Now look at the second column. In the second column, the company earns a 9% return on capital, exactly equal to the cost of capital. At a 9% return on capital, as I grow faster, the value doesn't change at all. It stays constant. Why is that? Because growth neither creates nor destroys value. I'm simply earning my cost of capital. It's sort of like being on a treadmill. You can get a good workout, you get sweaty, but in the end, when you're done with your workout, you're exactly where you started. You might argue that we're too negative about the low return on capital companies. Won't the return on capital increase as the company grows faster? In our experience, that's usually not the case. True, very small companies, startup companies in particular, as they grow faster, their margins typically do improve as they're able to generate economies of scale and spread their costs over a larger amount of volume. But for most companies, a low return on capital indicates a problem that needs to get fixed before the company focuses again on growth. For example, maybe the cost structure is too high, or the products may not be distinctive enough to command premium prices from customers. In our experience, companies in that situation need to focus on fixing those issues and increasing the return on capital before they turn to revenue growth. Where a business stands in terms of return on capital and growth has important implications for its strategy, particularly its choice of whether to focus on return on capital or growth. Let me give you an example. A high return on capital consumer products company, let's say, will receive a 10% increase in value for 1% of additional growth, whereas a more moderate return retailer might receive only a 5% increase in value for 1% additional growth because of its lower return on capital. The inverse is also true. The retailer will benefit much more from even modest improvements of its margins or return on capital, while the high return on capital consumer products company will not receive much of a benefit from improving its margins or return on capital. Of course, the simple analysis assumes that it's equally difficult to increase revenue growth as it is to improve return on capital, which is often not the case. It also makes the assumption that when you improve growth or return on capital, your return on capital or your growth will remain constant, which is clearly not the case. That leads us to our second chart, which shows that different types of growth often will generate different amounts of value because they generate different returns on capital. Recognizing that not all growth earns the same return on capital, this chart shows the value created for different types of growth. Now this chart is an example from the consumer products industry. Different industries might have a different rank order for different types of growth, but it's a useful illustration to think about the value of different types of growth. The numbers in this chart are scaled to show the value created for $1 of additional revenues. At the top of the chart, we see the value created from a company introducing a new product. New products, if they're successful, typically generate a very high amount of value per dollar of revenue generated. The reason for this is that often the additional costs for the company to sell that product are low. It often has existing manufacturing and distribution capabilities, for example. At the bottom of the chart, we show the value created from an acquisition. The reason that the acquisitions tend to create smaller amounts of value is that when you make an acquisition, unlike a new product introduction, you have to invest an awful lot of capital up front. You have to pay for the business plus typically a premium. And so even though you may create a lot of value in an absolute sense, there may not be much left over in terms of return on capital after considering the price that you've paid. So that's why acquisitions tend to generate smaller amounts of value relative to the amount of revenue that they generate. In between, you see some other sort of types of growth. For example, expanding an existing market. Right? If a consumer products company can get people to wash their hands more often, for example, there's not a lot of costs associated with selling more hand soap. And so the returns will tend to be high, and the value creation will tend to be high. If you look at the second to the bottom line, competing for share in a stable market, you'll see that the value created from this type of growth spans both negative and positive numbers. In other words, growing through competition in a stable market can actually destroy value because often that growth comes in the form of price wars. Price wars usually destroy value for everyone in an industry, particularly a concentrated industry. Now we've seen how the core valuation principle works. The value of a company is driven by the combination of its revenue growth and its return on capital. Next, we're going to turn to the second cornerstone, which is the conservation of value. Conservation of value is the corollary to the first principle. Conservation of value says that anything that doesn't increase the cash flows of the company that are available to its investors doesn't create value. In my discussion of the first cornerstone, the core valuation principle, we saw that the value of a company is determined by the combination of its growth and its return on capital, the two drivers of its cash flow. We'll now turn to the second cornerstone, the conservation of value, which is a corollary to the first cornerstone. Conservation of value says that anything that doesn't increase the cash flows of the company that are available for its investors doesn't increase its value. Here's a way to think about the conservation of value principle. Think of a pizza. I can cut the pizza into either 6 pieces or 8 pieces, but regardless of how many pieces I cut the pizza into, the total size of the pie doesn't change. It's the same for a company. Company generates cash flows, which are then distributed among different groups of investors. For example, equity holders and debt holders. It doesn't matter how those cash flows are distributed in determining the total value of the company, because the total value of the company is determined by the cash flows that the company generates, regardless of how it distributes them to its different investors. So unless I change the total cash flows coming into the company, I'm not going to affect the value of that company. I'm only going to affect the distribution of value among the different groups of investors. Understanding the conservation of value principle can help you differentiate from actions or decisions that merely redistribute cash flows from those that actually increase the cash flows of the company and therefore create value. The conservation of value principle rests on the pioneering work of 2 Nobel laureates, Franco Modigliani and Merton Miller. In the late 50s and early 60s, they explored the question of how the capital structure of a company affected its value. And what they showed was that it shouldn't affect the value of a company whether I had more or less debt relative to equity in the capital structure, because the total cash flows available to all the investors hadn't changed any. Unless the cash flows coming into the company changed as a result of the change in the capital structure, it shouldn't affect the value of the company. Here's an example of how this works. Let's suppose we have a company that has an enterprise value of $1,000 and it doesn't have any debt to begin with. So its equity value is also $1,000. Now what would happen if that company were to borrow $200 and use that $200 to repurchase shares from the equity holders? Once the company has borrowed the $200 and paid it out to the shareholders, The total enterprise value hasn't changed any because the cash flows coming into the company in terms of revenues, costs, capital expenditures haven't changed at all. The total of the debt plus the equity must still be $1,000. The only way the value of the company can change is if by changing the capital structure, it changes the cash flows coming into the company. One way that can happen is through the tax deductibility of interest expense. In most countries, interest payments are tax deductible. So it reduces the overall taxes of the company and increases the cash flows. So by taking on debt, I can reduce the tax burden of the company, increasing the total cash flows and the enterprise value, and I have more value then to distribute between both the debt holders and the equity holders. But it's not the change in capital structure itself that affects the value of the company. It's the fact that changing the capital structure changes the taxes that the company pays. And that's what changes the value of the company. So increasing the debt of the company can increase the company's cash flows two ways. One, through the lower tax burden that the company has to pay. And secondly, through the improved monitoring of the company by the creditors, which makes it less likely that the managers of the company will make frivolous investments with the cash flow that the company generates. That might lead you to think that companies should take on lots and lots of debt in order to increase their value. Now, there's a negative effect from debt as well. The negative effect of debt is that by taking on debt, the flexibility of the company and the attractiveness of that company as a business partner, as a customer or supplier, is less attractive. So the benefits of debt, the reduction in taxes and the reduction in frivolous investments, have to be weighed against the cost of debt, namely the reduced flexibility of the company and the fact that it becomes a less attractive partner as a customer, supplier, or even as an employer for potential employees. The conservation of value principle is so useful for executives because it provides us a way to think about whether an action creates value or not. And that can be applied to questions of accounting policy, acquisitions, dividend policy, capital structure. A whole range of issues can be looked at through the lens of the conservation of value principle. For example, the only way to create value from an acquisition is when you put the two companies together, the combined cash flows of the two companies operating together are greater than what they would have been separately. It's not a matter of things like EPS accretion, dilution, or other factors like that. It's really about, do the cash flows of the combined entity increase when you put those two companies together? You can also apply this to things like accounting policy. For example, one of the most controversial accounting issues over the last 10 years was the treatment of executive stock options. For years, executive stock options were not treated as an expense in a company's income statement, despite the fact that there was clear value being distributed to those managers. The United States Financial Accounting Standards Board recognized this flaw as options became more important and proposed a rule change that would require companies to record options as an expense when they were issued. Many executives and venture capitalists were opposed to this rule because they assumed that the stock market would be confused by the accounting change. They assumed that the expensing of stock options, which would reduce reported accounting income, would lead to lower stock market values because the market would not differentiate between the economic change and the accounting change. Now, we know that simply changing the accounting rules is not going to change the cash flows of the company or the way that the value is going to be distributed. And in fact, that's exactly what happened. When the new accounting rules came into play, reported corporate profits did go down, and for some companies went down quite a bit, companies that relied on stock options quite a bit. But there was no evidence that the values of companies changed as a result of it. So in other words, the stock market was smart enough to realize that the accounting change didn't change cash flows or the distribution of value, so equity values didn't change. Or consider financial engineering, which is the use of complex financial instruments instead of simple debt and equity. Is there any benefit from using complex financial instruments instead of simple debt and equity? In most cases, The use of complex financial instruments like convertible debt or off-balance sheet debt or sale and leaseback arrangements doesn't affect the total amount of cash flows coming into the company. So therefore, they neither create nor destroy value. They simply change the way we distribute that value across different sets of investors. So once again, by looking through the lens of does the transaction increase the total cash flows available to the company, we can see whether or not it affects the value of the company. But there are examples where complex financial structures do create value. Take the example of hotel companies. Hotel companies often create separate legal entities to own the hotels versus those that operate the hotels. And the reason for that is that they can structure the ownership companies in a tax-advantaged way according to the tax laws in the US and a couple of other countries. So by creating a more complex structure, the total taxes paid by the entity are lower than what it otherwise would be, and that leads to the value creation. But once again, this points out that in order to understand the value creation from complex financial transactions, we need to understand the effect on total cash flows. And if the transaction increases those cash flows, it may very well create value. If it doesn't increase the cash flows, it's not likely to create value, and more often than not, will destroy value because it introduces complexity and legal and other costs in order to create these structures. As a rule, executives should exercise caution when faced with transactions where it's not clear how that transaction will lead to an overall increase in the cash flows of the entire company. Always ask, what's the source of value creation? How are the total cash flows going to increase as a result of this transaction? So we've seen how value is created and destroyed through the first two cornerstones. Next, we turn to how value is reflected in the stock market. Now that we've explored how companies create and destroy value through the first two cornerstones, let's turn to how value and the stock market interact. Many executives spend tremendous time watching their share price. And sometimes they make strategic decisions based on what they see happening to their share price. So it's critically important that executives have the proper interpretation of movements in their share price. Otherwise, it could lead them to value-destroying strategic decisions. We call this third cornerstone the expectations treadmill. Let me explain why. The value of a company is a function not just of its actual performance, but of the expectations of investors about future performance. So the only way that a company's share price can increase faster than the market is if they are continually able to increase the expectations of investors about their future performance. The problem is that once I've improved my performance and met the investors' expectations, in order to increase their expectations again, I have to improve performance and bring it to another higher level. So I'm in a continuous cycle where the only way that I can outpace the market is by continually beating expectations. But those expectations, if I continually beat them, will keep going up. Eventually, the expectations will become so high that I can no longer beat those expectations. That's why it's not unusual for companies with great performance in terms of return on capital and growth to have just normal share price performance, because they can no longer beat the expectations that are built into their share price. I'd like to illustrate this with an example comparing two companies, Target and Walmart, two of the largest US-based retailers. From 1995 to 2005, Target shareholders earned an annual return of 24% per year. That includes both dividends and share price appreciation. Walmart's returns, on the other hand, for shareholders were 15% per year. So Target shareholders earned 9% per year more than Walmart shareholders. But what does that tell us about whether Target created more value or Walmart? It actually doesn't tell us very much. And we can see that when we disaggregate those return to shareholders into their components. The top three components are the actual underlying performance of the companies. Growth, cash flow generation, less investments that they required for growth. Down below, we look at the change in investor expectations as measured by the multiples. And then finally, we also look at the impact of financial leverage. So let's explore each of these. When we look at the return to shareholders, the TRS, from performance, from actual performance, you see that Walmart actually outperformed Target 10% per year to 8% per year, right? And you can see also, if we dig deeper, we can see why that's the case. Walmart grew revenues 13% a year, while Target only grew 9% a year. On the other hand, Target improved its margins during this period, where Walmart's were flat. That doesn't mean that Walmart's margins were not good, and in fact, this represented more of a catching up of Target to Walmart's level of margins. And then finally, we have to subtract off, in terms of performance, the investments required in order to achieve that growth. So in terms of actual delivered performance, Walmart outperformed Target 10% per year to 8% per year. Target's shareholders benefited more from improvements in the expectations of performance as an important driver of their return. And let's explore how that works. We see we have two elements here that explore the effect of expectations. The first element, called the total return to shareholders assuming no growth. What this does is it reflects the way the companies were valued at the beginning of the time frame, back in 1995. Back in 1995, Target had a price-earnings ratio of 11, while Walmart's price-earnings ratio was 15. So the starting point in terms of delivering return to shareholders, Target was already advantaged because the expectations, as reflected in the lower price-earnings ratio, were much lower. So they didn't have to deliver as much in order to meet the low expectations that were built in to Walmart's price. And that favored Target by 2%. The next element reflects the change in earnings multiple, or the change in expectations. The first part measured the beginning level of expectations. The change in multiple measures the change in expectations. You can see here that Target's multiple increased substantially, leading to 5% per year of additional return to shareholders from the increase in the multiple, effectively catching up with Walmart. Walmart's multiple was essentially flat, leading to no improvement in the shareholder returns. So these two elements combined represent a total 7% advantage for Target shareholders, because Target had a lower valuation at the beginning of the time frame, and the expectations, which started out lower, gradually increased to catch up with Walmart's expectations. So an entire 7% of the difference between the two returns is driven by the expectations of Target catching up to the expectations for Walmart. The final element I'd like to discuss is the impact of financial leverage. When a company has lots of debt, small changes in performance in the overall performance of the company are magnified by the effect of debt to greater changes for the shareholders. And that's what happened here. At the beginning of the time frame, Target had much more debt than Walmart. And as a result of that, the improvements that Target made, both in terms of the underlying performance and the expectations, were magnified to the shareholders because of their high leverage. And that led to an additional 3 percentage points of improvement in value per year for the shareholders. So when we look at the total difference in shareholder returns, we see that basically all of the outperformance by Target was due to bringing up the expectations from a very low level to a level similar to Walmart, and to the fact that they had greater financial leverage at the beginning of the time frame. Now, by the end of the time frame, Target had similar financial leverage to Walmart. Now, if I were to look forward and say, well, what can happen now going forward? What's the likely differences in return to shareholders going forward? Now we're starting out with a point where the two companies have similar financial leverage and similar expectations, as embodied in similar price-earnings ratios. So without further changes in those variables, which are unlikely, the only way that Target can beat Walmart going forward is by increasing their real performance, not just by improving expectations. So the expectations treadmill has important implications for measuring the performance of a company and for executive compensation. Take executive compensation. Over periods of 3 or even 5 years, most of the movements in a company's share price are going to be driven by changes in expectations and the resulting multiple rather than the underlying performance of the company. So by compensating executives based on TRS, we're typically compensating them more for changes in expectations rather than delivered performance. And that may work against high-performing managers who are in a starting point with high expectations and work too much in the favor of managers who are simply beating low expectations. It's not that TRS is a bad measure or we shouldn't use it, but we need to understand what are the components of return to shareholders. As we talked about in the case of Walmart versus Target, how much of that TRS is coming from underlying performance? How much of that TRS is coming from changes in expectations? It also has important implications for looking forward. If, for example, I've had a high return to shareholders over the last 3 years because my expectations at the beginning of the period were low and now they've been brought up to the average of my peers, it's unlikely that I can expect my expectations to continue to outpace the peers. So my TRS is likely to be more in line with my peers or more in line with my actual performance rather than outperforming. On the other hand, it may also help me understand why very strong companies or very strong managers who had a tremendous amount of real performance in terms of revenue growth and returns on capital didn't outperform their peers in terms of return to shareholders because they already had high expectations built into the share price. So it's important to disaggregate return to shareholders into the key components of true underlying performance and the effect of expectations and changes in expectations on those returns to shareholders. The expectations treadmill also has important implications for investors. It shows investors that there's a difference between a good investment and a good company. A good investment may be to invest in a company which has very low performance and low expectations. As long as that performance improves even a little bit and the expectations improve a little bit, the share price will likely outperform other companies. On the other hand, a good company with good growth and good returns on capital may be a lousy investment if all the other investors already expect it to perform well and those high expectations are built into its share price. In other words, since it won't be able to outperform expectations, the share price is not likely to outperform the market. Now we've seen how companies create and destroy value and the interaction between that value and prices in the stock market. In the next and final cornerstone, we'll explore how different owners can lead to different values for the same business. We've explored how businesses create value and how that value is reflected in the stock market. Now we're going to explore how value varies depending upon who owns a particular business. This is important because one of the levers that companies have to create value is the decision when to own a business. Should they dispose of businesses that they're currently owned, or should they acquire businesses that they don't own? We call this the best owner principle because value is maximized when a business is owned by the owner who is uniquely positioned to extract the most value from it. Let me illustrate with an example. In 2001, General Mills purchased the Pillsbury division of Diageo for $10.4 billion. Shortly thereafter, General Mills increased the cash flows and operating profits of the Pillsbury business by $400 million per year, increasing Pillsbury's value by 70%. How did they do that? A couple of things. One, they were able to use Pillsbury's refrigerated trucks to distribute a new line of refrigerated products that General Mills was introducing. So General Mills didn't have to go out and sort of build the whole fleet of trucks. Secondly, General Mills was able to introduce some Pillsbury products into the U.S. school market, where General Mills already had a strong presence and distribution system. And finally, as with many acquisitions of overlapping businesses, General Mills and Pillsbury used similar distribution and manufacturing processes, and they were able to consolidate some of those activities. Total effect was to increase the value by 70%. Diageo couldn't have done these same things with Pillsbury because Diageo's core business was manufacturing and distributing alcoholic beverages with very few overlaps with Pillsbury's businesses. This example also shows that there is no intrinsic value for a business such as Pillsbury's. It depends on who the owner of the business is. Let's look at how this works. The first column represents the value of Pillsbury to General Mills, including all of the benefits that we just talked about. The value to Diageo is by definition much less because Diageo can't extract those same benefits from owning the business. The transaction price of $10.4 billion is presumably somewhere between the value of Pillsbury to General Mills and the value to Diageo. So both parties benefit from the transaction because they're able to split the value increase that comes from General Mills' better ownership of Pillsbury. We find that it's particularly important for investors to identify the sources of better ownership. This helps them think through whether in fact they are the best owner of a particular business or whether someone else might be and they are better off divesting that business. Let's now explore the different sources of best ownership. The most straightforward source of best ownership is unique links between a business and other parts of the company. Consider a coal mining company that has an established mine with fully developed infrastructure, railroad lines, power plants, etc. Now suppose that a coal mining opportunity opens up on an adjacent piece of property. The company that already has that infrastructure leading to that area is likely to be able to operate the new mine at a much lower cost than any other competitor. So it has a natural best owner advantage over any other operators. That's one example, unique linkages. A second source of best ownership is distinctive skills that a company can bring to a business. Now these can occur anywhere in the business system, from product development to marketing to manufacturing. But of course, those skills have to apply to a part of the business which is critical to that business's success. Being a great manufacturer, for example, isn't going to be important to let's say, a consumer products company where the most important skills are product development and marketing. Procter & Gamble is a good example of a company with distinctive skills. It has distinctive skills in the development and marketing of consumer branded products. Procter & Gamble currently has 23 products with more than $1 billion in sales and another 20 products with more than $500 million in sales. Some of these products have been around for 50 years, some have been purchased recently, and some have been developed from scratch in the last 10 years. In all those cases, though, Procter & Gamble does an extraordinary job of building those brands and keeping them at the top of their market. A third source of better ownership is better governance. Private equity firms are an example of better governance. The best private equity firms don't just buy companies and hope to sell them at a higher price and use a lot of debt. The best private equity firms don't create value through financial leverage. They create value through improving the underlying performance of the businesses that they own. They don't have time, though, to run the businesses on a day-to-day basis. So what they do is they rely on better governance. And what that means, they work with managers to instill a stronger performance culture. They help managers overcome or abandon any sacred cows that exist in the business. And they'll often work with managers to help change the time horizon of the managers so that the managers can focus on value creation, let's say over a 5-year period instead of a 1-year period. So it's the better governance that ultimately leads to value creation from private equity firms. A fourth source of better ownership is better insider foresight. What this means is that a company can see into the future better than others because of some existing businesses or other sort of advantages that it has. For example, the software company Quicken noted that many small business owners were using their consumer finance software to run their small businesses. The reason was that existing small business software was too complex for many of them. That insight helped Quicken to develop an accounting software for small businesses that was much easier to use than the other products on the market. And they were able to quickly gain a substantial share of the market as a result of that insight. The fifth and final source of best ownership is distinctive access to talent, customers, or suppliers. We typically find these in emerging markets only, because in emerging markets, it's not unusual that the pool of managerial talent may be very limited, and larger, better-known companies may have a better chance at attracting the best managers. And also in some of these markets, to be successful, you have to navigate significant government bureaucracies. And only the larger, better-known companies have the resources and contacts to be able to do this successfully. That's also why you often don't find distinctive access to talent or customers or suppliers as a source of advantage for companies in developed markets. The best owner of a business will also change over time. When a company is new, the founders who had the original idea are typically the best owner. But as the business grows, the founders may need to bring in professional managers and venture capitalists to provide the capital and management skills to bring it to the next level of size. As the company further develops, it may need new distribution capabilities that it can't build on its own. And it might be worth more in the hands of a large company that has significant distribution and manufacturing capabilities. Unfortunately, in our experience, too few executives understand truly whether or not they are the best owner of each of the businesses that they're responsible for.